Welcome. Where, and Dumalang, Molo, Sawubona, Hukandat, and a warm welcome to the Induvo Knowledge Cast, the podcast where your curiosity meets insightful conversations. And today, we're diving headfirst, no life fest, into the world of IFRS. You know those international financial reporting standards everyone's talking about. But hold on, before you hit that skip button thinking this is just another boring accounting lecture, we promise this deep dive is specifically for you.
That's right. If you're a South African business wondering how to even start with this whole IFRS thing, you've come to the right place.
Think of it like this. We're taking that leap from, let's say, balancing your checkbook, the old school way, to managing the books of a global empire. Okay, maybe not a whole empire just yet, but a business ready to make waves internationally. And lucky for us, we've got the ultimate guide right here.
IFRS 1, it's the standard, literally, for anyone adopting IFRS for the very first time. Think of it as, those instructions you get with those self-assembly braai stands. Except, instead of ending up with wobbly legs and questionable sausages, you get clear, internationally recognized financial statements.
Now that's an image I can get behind. So for those who might still be a bit fuzzy on the why should South African businesses even care about IFRS?
Imagine this. You've got this amazing business right here in Mzansi, making the best biltong the world has ever tasted. You're ready to export, share it with everyone. But there's a snag.
Let me guess. Customs only speaks French.
Close. The investors, the big leagues, they're all looking at your financials and they're like, ish, what's going on here? Different accounting standards, different countries. It's like everyone's speaking a different language about money.
A recipe for chaos, just like that time I tried to follow a recipe for my aunt. She forgot to mention the whole soak the beans overnight part. Disaster.
Exactly. But IFRS, it's like this universal language for business. It allows everyone, everywhere, to understand your financial statements.
So it's less about the biltong itself and more about how those numbers tell the story of your biltong empire to the world.
You got it. IFRS opens doors, attracts investors, and puts your business on the global map. It's like, I don't know, winning the entrepreneurial version of the Rugby World Cup. Everyone knows your name. Everyone wants a piece of the action.
The Springbucks of the financial world. Okay, I'm sold. IFRS equals global domination. But let's get real for a second. This IFRS 1, this guidebook, what's the most crucial thing it wants to see in a company's very first set of IFRS financial statements?
Well, imagine those judges for a singing competition, right? They want to see that X factor. That's something special. For IFRS 1, that X factor is all about those financials being crystal clear, consistent, and a true reflection of where your company stands financially.
So it's more than just swapping out a few numbers here and there from our old way of doing things. No more creative accounting.
Icona. We're talking a complete makeover, a whole new wardrobe for your financial statements. It's about understanding how to recognize and measure your assets and liabilities under this new IFRS lens.
Assets and liabilities, those sound a bit technical. Can you give us a relatable example?
Sure, let's say your company owns a delivery van, right? The one with the slightly dented bumper and a questionable smell coming from the backseat.
Who hasn't had one of those?
Under your previous accounting, you might have recorded it at its original cost, what you paid for it back in the day. But with IFRS, you might need to revalue that van to its fair value on the day you switch to IFRS.
Wait,
Meaning you need to figure out what that dented, slightly fragrant van is actually worth in today's market. Could be more, could be less. IFRS wants that real talk.
So it's all about being honest, transparent, presenting a true picture of your company's worth on this global stage.
Precisely. And that's just one example. This whole concept applies to all your assets and liabilities, inventory, equipment, loans, even those questionable investments your brother-in-law convinced you to make.
We've all been there.
IFRS 1 wants to make sure everything is measured and reported correctly right from the get-go. And that brings us to this rather important document, your opening IFRS statement of financial position.
Ooh, that sounds serious. Very official, like something you'd only discuss in a boardroom with fancy leather chairs. What exactly is this statement?
Think of it like this. It's your balance sheet, all dressed up in its finest outfit, ready to make its grand debut on the international stage. It's your company's financial coming out party. But instead of awkward introductions and questionable snacks, you've got IFRS standards stealing the show.
And first impressions matter.
Absolutely. Your opening IFRS statement of financial position, it's the foundation, the starting block for everything IFRS going forward. It's your company's big break, its chance to shine under the IFRS spotlight. And to make sure everything runs smoothly, to make sure you don't trip on the red carpet, IFRS 1 stresses the importance of Drumroll, please. Accounting policies.
Ah, yes, those ever so thrilling accounting policies. Everyone's favorite topic at a party, right? But seriously, why are they such a big deal under IFRS 1?
Consistency, my friend. Consistency. It's like that time you tried to build those flat-pack bookshelves from that Swedish store.
Don't remind me, those things still haunt my dream.
Exactly. You wouldn't use the instructions for a braai stand to build those bookshelves, would you? It's about having a clear set of rules, a method to the madness so your financial statements make sense, and more importantly, so they can be compared year after year.
So no more changing your accounting methods as often as we change channels during the adverts. IFRS 1 wants us to pick a lane and stick to it.
You got it. Whether it's how you depreciate those delivery vans, how you value those boxes of biltong, IFRS 1 wants you to be clear, consistent, and oh so transparent.
Transparency. That seems to be the name of the game with IFRS. But let's be honest, switching accounting systems is a bit like trying to teach a rhino to waltz a lot of effort for a somewhat ungraceful outcome. So, any lifelines for us first-timers? Does IFRS 1 offer any exceptions, to ease the pain?
Don't worry, IFRS 1 gets it. It understands this whole transition can feel a bit like load shedding, unexpected, and a bit frustrating. So yes, there are some built-in exceptions and exemptions, little pockets of relief in the world of IFRS.
Okay, tell us more. We South Africans love a good exception.
Well, take past business combinations, for example. Imagine you've acquired a few other companies over the years. Now, imagine trying to restate all those past acquisitions under IFRS. A real headache, right?
I can already feel the aspirin kicking in.
Exactly. So IFRS 1 says, relax, take a breath. You don't have to go back and apply IFRS 3 to every single past acquisition.
Phew, that's a relief. Any other exemptions our listeners should know about?
Financial instruments are another area where IFRS 1 throws us a bone. Now, IFRS 9, that's the standard that deals with all those complex financial things like shares and bonds warring. It can get pretty intense.
Sounds like a whole other deep dive waiting to happen.
It is. But the good news is IFRS 1 gives you some breathing room, especially when you're first measuring those financial assets and liabilities. It's like a little grace period before you have to master the art of IFRS 9.
Every bit helps.
Yeah.
But it's not enough to just present the numbers in this new IFRS format, right? We've talked about transparency, showing your workings, and that brings us to everyone's favorite, disclosures.
Ah, disclosures. Those essential footnotes and explanations that add color and context to your financial statements. Think of them as the spices to your financial bunny chow. They bring out the flavor, the depth.
So we can't just serve up a plate of plain rice and call it a day.
Exactly. You need those disclosures to tell the story behind the numbers. This is where reconciliations come in, those handy explanations of how you got from point A, your old accounting, to point B, those shiny new IFRS figures.
Like leaving a trail of breadcrumbs, so the auditors don't get lost in the woods of your financials.
Precisely. Transparency builds trust, and those disclosures are your way of showing the world you've got nothing to hide.
Makes sense. Now, before we get too lost in the world of disclosures and reconciliations, you mentioned something earlier about a deemed cost. What's that all about? Sounds intriguing.
Deemed cost. It's like that spare set of keys you keep hidden just in case. Sometimes IFRS 1 allows you to use the fair value of an asset, its current market value, as a starting point instead of digging through years of paperwork to figure out its historical cost.
So instead of spending hours in the basement archives, we can just take a shortcut. Sign me up.
Well, not so fast. IFRS 1 has some rules around when you can and can't use this deemed cost magic. It's generally allowed for things like property, plant, and equipment, like those delivery vans we talked about, buildings, machinery. Even those intangible assets like licenses and patents, those can qualify too.
So, no applying deemed cost to your collection of vintage Springbok jerseys, even if you're convinced they're worth a fortune.
I'm afraid not. It's all about being sensible, about applying professional judgment and staying true to those IFRS principles of fair presentation.
It's all about finding that balance, just like a good Gatsby, not too much sauce, not too little. Now, let's say our listener is part of a bigger group of companies. Maybe their parent company adopted IFRS a while back, but now it's their turn. How does that work? Does IFRS 1 have any advice for these situations?
Absolutely. IFRS 1 understands that not every company in a group will transition to IFRS at the same time. It's like a family braai. Someone always forgets the matches, and you're stuck waiting.
And we South Africans know how long those braais can last. So what happens when one part of the group is already grilling on IFRS and the other is still figuring out the firelighters?
Well, IFRS 1 provides some guidance on how to keep the financial reporting in sync, avoid any family feuds. Let's say a subsidiary is adopting IFRS later than its parent company. It has a couple of options when measuring those all-important assets and liabilities.
Options are always good. Lay it on us. What are our choices here?
One option is for the subsidiary to align its figures with what's already on the table, so to speak, in the parent company's consolidated financial statements. They'd use the parent company's date of transition to IFRS as their starting point.
So it's like showing up late to the party, but luckily someone saved you a plate of Coke Sisters. You benefit from their early arrival.
Exactly. This approach keeps things nice and tidy, ensures everyone's singing from the same hymn sheet, financially speaking, right from the start. But of course, the subsidiary can also choose to go their own way, follow the standard IFRS 1 procedures using their own transition date.
But that might mean more paperwork, more late nights, reconciling everything with the parent company down the line, right?
It could, yeah. It's all about weighing up those pros and cons, seeing what makes the most sense for each company's unique situation.
Just like choosing between a Boer Wars roll or a bunny chow, both delicious, just depends on your appetite for complexity. But on that note, as much as we love dissecting those accounting intricacies, I think our time is just about up. Before we let you go, any final words of wisdom for our listeners who are about to take their first steps into this world of IFRS?
Remember, IFRS might seem a bit daunting at first, maybe even as intimidating as facing the All Blacks in a scrum. But it's ultimately about making your financial reporting clearer, more reliable, understandable to a global audience. Think of it as learning a new language, one that opens doors and helps your business thrive on the world stage.
It's like finally cracking the code, understanding the secret handshake of international business. And on that note, we've reached the end of our IFRS 1 deep dive. We hope you've enjoyed the ride, learned a thing or two, and maybe even cracked a smile along the way. Until next time, happy accounting.